Welcome to the deep dive. We're here again to take a pretty complex pile of research and analysis and really try to turn it into something actionable, something insightful for you.
Yeah, and today the stack is truly sprawling. I mean, we've got sources covering everything from, 19th century monopolies
hmm
all the way through insider trading, the mechanics of modern finance, and even the future of AI, particularly looking east towards China.
That's a lot of ground.
It is. But our job really is to show you how these seemingly diverse stories are actually all circling the same core questions. How is power really consolidated today? How does wealth get concentrated? And maybe crucially, what happens when that kind of ambition runs unchecked?
Right. So our mission isn't just to give you a summary. We want to genuinely unpack uh, the new rules, maybe the structural rules of global success. We want to analyze those hidden costs of ambition we talked about and draw out the common threads. Sometimes they're quite surprising, these threads of disruption and accountability across all these different fields. Basically, we want to give you the context, the real story behind the headlines you might be seeing. Okay, let's unpack this. And maybe the best place to start is, well, arguably the biggest shift happening right now geopolitically, economically. I mean, the migration of economic power into these proprietary data systems, especially when we look at China.
Absolutely.
Yeah.
And the sources we looked at, they really highlight two critical transitions that are fueling this whole shift in tech dominance.
Uh,
The first is this move from what you might call the age of discovery
yeah.
to the age of implementation. Discovery's done, now it's about doing. And the second, which is maybe even more profound, is the shift from the age of expertise to the age of data.
Okay. Explain that distinction. Age of expertise to age of data.
Well, the core insight here, and it comes through really strongly in the material, is that while the West, specifically through academic research, corporate R&D into deep learning, while the West might have sparked the fire, the overwhelming consensus in these analyses is that China is just structurally positioned to be the biggest and probably the fastest beneficiary of the heat that fire is giving off.
That's a pretty big claim. So the breakthrough happened maybe in the West, but the advantage now goes to whoever can apply it best. But why? Why are the sources so sure that China, and not, say, Silicon Valley, is set to dominate this age of implementation?
It really comes down to what the sources are calling this unique Chinese digital ecosystem. And the first thing we have to do is sort of shed that old habit. Using those simple comparisons like calling Tencent the Facebook of China or Alibaba the Amazon of China, it just doesn't capture anymore. Their platforms have evolved. Fundamentally, they've gone way beyond the scope of their typical American counterparts.
Okay, so give us a concrete example then. How have they evolved?
Well, the perfect example is WeChat. Here in the U.S., our apps tend to be pretty specialized. You've got one for messaging, maybe another for banking, one for social media, right? WeChat, though,
Yeah.
it's morphed into what one source really nicely called a digital Swiss Army knife. Think about that. Within that single app, you have hundreds of millions of people doing this huge range of daily stuff. Yes, the core messaging is there, but they're also paying at the grocery store. They're ordering meals delivered to their homes. They're paying their utility bills, even booking doctor's appointments. It's less like an app and more like an operating system for your life.
Wow, that level of integration, I mean, the amount of behavioral data that must generate is just staggering. And this whole ecosystem, it's built on a few key pillars, isn't it?
Yes, exactly. The sources point to three crucial building blocks for this foundation. First, you've got this massive user base, and critically, they're mobile first. Many skip the whole desktop PC era entirely.
Sure.
Second, this national super app model where platforms like WeChat just handle almost everything, centralized control. But the third factor, and this is maybe the most decisive one, is the incredibly widespread adoption of mobile payments. I mean, the sources point out that Chinese cities effectively became the world's first truly cashless environment since the barter economy. Just think about that. Almost every single transaction is digital.
And that mobile payment data, that's the real gold mine here. We should probably be really clear for you listening. Why is this data so much better, so much richer than, say, the data Amazon gets from your purchases or Google gets from your searches?
Yeah, this is where that structural advantage really snaps into focus. Mobile payment data, it generates what the sources are calling the richest maps of consumer activity the world has ever known. Think about it. A typical credit card transaction. Maybe it captures a big purchase you make at a national store once a week, something like that. Google or Yelp, they capture your search intent, maybe some reviews. But Chinese mobile payments, They capture the substitution of cash. That means they get data on the tiny transactions, small vendor purchases, street food, your daily bus ride, even cash gifts between people. It's incredibly granular, it's everywhere, and crucially, it links your online digital life directly to your offline physical world actions in real time.
Okay, so it's not just the sheer volume of data, which is obviously huge, but it's the depth and the completeness of that activity map. If you're trying to train an AI to predict what consumers are going to do next, having that kind of comprehensive real-world data, well, it's just infinitely more valuable than, say, fragmented credit card logs or search histories.
Precisely. That comprehensive data becomes absolutely invaluable if you're trying to build AI-driven companies in these massive, traditionally complex sectors. Think retail, logistics, real estate. In this age of implementation, we talked about the AI algorithms. They're only as good as the fuel you feed them. And right now, China is sitting on a virtually limitless supply of this really high-octane behavioral data fuel.
And they've got the scale to just leverage this like crazy, right? The sources mention over 700 million internet users, all consuming content in the same language. That kind of massive homogeneous scale must let these Chinese tech giants optimize their online services incredibly fast using AI. It leads to these huge jumps in efficiency, market saturation.
Oh, absolutely. And we saw this scale translate into hard financial power really, really quickly. Look at Tencent. Leveraging its platform dominance, it actually surpassed Facebook's market cap back in November 2017. And it's not just the established players. You see this aggressive growth from newer companies built entirely on this model. Companies like Tuxiao generating these multi-billion-dollar valuations, basically because their whole business is internet AI, fueled by this hyper-rich data. The massive profits they generate, they stem directly from the AI's ability to hold our attention longer, to harvest our clicks or transactions, just more efficiently than anything we've seen before.
But I do have to push back slightly here. That caveat you mentioned earlier about a potential new deep learning breakthrough, doesn't that suggest the sources might be, I don't know, overstating China's long-term lead a bit? What exactly does the analysis say about that risk? The risk of stagnation versus a genuine paradigm shift happening somewhere else.
That's a really crucial point, and there is some friction there in the sources, you're right. One analysis does suggest that if a totally new paradigm shift emerged, something as fundamental as deep learning itself was maybe out of academia or more open-ended research, then yeah, it could temporarily shift the balance of power back towards, say, the U.S., where maybe that elite fundamental research expertise still has an edge. However, the consensus in the sources, for now at least, is that the corporate giants on both sides, U.S. and China, they're mostly focused on industrializing, on optimizing the current deep learning paradigm, not discovering the next one. So the advantage right now lies with the structure that can implement the existing tool most effectively. And that appears to be the Chinese system, fueled by all that proprietary data.
Okay, here's where it gets really interesting for me. Because if data is essentially the new capital, and controlling that data is creating these vast new fortunes, how does that connect to the, let's say, the historical rules of wealth accumulation and inequality? So now we're moving from that digital frontier back to the sort of structural architecture that drives concentrated wealth everywhere. Hashtag Tech 2, the architecture of concentrated wealth and inequality.
Exactly. And this brings us right to a really critical economic concept, one that's rooted in deep historical analysis of capital accumulation. The sources look at centuries of data, basically, and they find that inequality often follows this kind of structural U-shaped curve over really long periods. It tends to compress, to lessen during major upheavals like world wars or the Great Depression, but structurally, inherently, it always seeks to expand again. And the single most significant mathematical driver, the thing underpinning this long-term concentration of wealth, is this little formula known as Jiri-Agree.
Right, 3G dole. Let's definitely spend some time breaking that down. It sounds a bit academic, maybe, but the sources are clear. It's absolutely central to understanding why some fortunes just seem to grow effortlessly while others really struggle.
Absolutely essential. So $30, that stands for the rate of return on capital. Basically how fast wealth grows if you invest it through dividends, interest, rent, capital gains, whatever. And D dollars, that's the rate of economic growth overall. Typically, this reflects how fast national income is growing, how fast wages are growing, essentially, income from labor. Now, the core finding, the crucial part, is when $3 is significantly and durably higher than B dollars, when returns on capital consistently outpace overall economic growth. The whole system fundamentally tilts in favor of the past, you could say, over the future.
Okay, so let me see if I've got this. If your inherited fortune, your capital, is earning you, say, 5% a year, But the overall economy, which is what drives your wage growth if you work for a living, is only growing at 2%. Then the gap between people who own capital and people who rely on selling their labor, it just widens automatically year after year. It's baked in.
That's the fundamental conclusion, yes. The past literally tends to devour the future, as one source puts it. It means that inheritance fortunes built up decades, maybe even centuries ago, naturally becomes more dominant than saving, which is wealth you accumulate now through your work. This dynamic just ensures that inequalities created in previous generations carry disproportionate weight today. And what makes this so durable now? Well, a big factor is the financialization of everything. Global capital can now chase the highest returns anywhere on the planet with very little friction, which helps keep that $2 consistently high for those who have significant capital to begin with.
And what does that wealth actually look like on the ground for most people? The sources mention that in rich countries, wealth is sort of split roughly 50-50 between real estate and financial assets.
Broadly speaking, yes. But the distribution of the returns on that wealth is incredibly unequal. For the average person, maybe their main capital is their home, perhaps a small savings account, a checking account. The return on those liquid assets like savings or checking, it's tiny. Sometimes it's even negative once you factor in inflation. And it's important to get the scale right here. Those non-interest-bearing accounts, like your basic checking, they currently make up only about 3 to 4% of total national wealth. So the returns for the average person are just negligible compared to what major capital holders can achieve.
Right. And you mentioned this structural concentration. While the sources do suggest that wealth inequality today isn't quite at the extreme peaks of, say, the Belle Epoque a century ago when the top 10% held something like 90% of everything, it's still dramatically concentrated, isn't it?
Oh, absolutely. Today, that top decile, the top 10%, they hold around 60 to 65% of total wealth. So still hugely concentrated. The key difference now, this is something we should really define clearly for you listening, is the existence of what the sources call the patrimonial middle class. This is a group larger than before that owns a significant chunk of national wealth, maybe about a third, primarily through their homes and their pension savings. They're distinct from the working class, who own very little capital, but they're also very distinct from that ultra-wealthy top decile. However, even this patrimonial middle class, they find their own capital growth increasingly challenged by the sheer power of that high dollar being generated right at the very top.
And the structural advantage at the top, it's constantly being, let's say, enhanced or turbocharged by modern financial engineering techniques. The sources specifically point to the rise of private equity, PE, and the leverage buyout, the LBO model, as a major modern mechanism reshaping corporations and consolidating capital.
That's right. The LBO model kind of had its big bang moment with a deal involving a company called Houday. Firms like Blackstone, KKR, they really grew by first acquiring family-owned businesses. And then later they scaled up, moving into buying out large publicly traded companies. Now, LBOs often get this, unfair caricature as just being strip and flip operations, buy it, gut it, sell it fast. But the sources we looked at actually offer a more nuanced defense. They cite studies suggesting that PE-owned companies that eventually go public again actually tend to perform better than average. And the failure rate for companies that go through LBOs, it seems to be comparable to, or maybe even a bit lower than, other similar companies that don't go through LBOs.
Okay, but we need to dig into the mechanics of leverage here. How exactly does an LBO use debt to restructure control? And what does all that leveraging mean for the risk profile of the company being bought?
Yeah, it's really all about financial mechanics and, crucially, risk transfer. In a typical LBO, the private equity firm uses huge amounts of borrowed money. That's the leverage to actually finance the purchase. But here's the key part. The debt is often secured by the assets of the company being acquired, not primarily by the PE firm's assets. So once they own it, the PE firm comes in, restructures the company, maybe sells off underperforming divisions, streamlines operations, cuts costs, and the goal is usually to sell the company or take it public again within a few years, hopefully at a much higher valuation. This whole mechanism lets the PE firm control a massive company with relatively little of their own initial money down, which massively increases their potential rate of return, their total as it works out. But the risk, the burden of all that debt, that gets transferred directly onto the company that was acquired.
Right. So when it's successful, it dramatically accelerates dry dollars for the investors, reinforcing that whole draw-Joe dynamic we talked about. But the sheer speed, the scale required for this kind of high-stakes financial maneuvering, it seems almost inevitable that it leads to cutting corners sometimes, and occasionally, as the sources show, with truly devastating results.
And that takes us directly from the sort of clean architecture of financial control right into the messy reality of the ethical and legal failures that happen when that kind of immense ambition collides with systems that just don't have adequate checks and balances. And we see these patterns of deception, of circumventing accountability, repeating themselves across decades, across different industries.
Let's start with a really high-profile recent example, the spectacular collapse of Theranos. The sources go into quite a bit of detail on the specific mechanisms of deception Elizabeth Holmes used, particularly how she managed those early beta tests with big corporate partners.
Yeah, the deception there was really built on exploiting trust and, frankly, non-disclosure agreements. Theranos managed to take over blood testing at an employee health clinic right there at Safeway's corporate campus in Pleasanton. This was meant to be a beta run, a real-world test of their technology. But what Safeway was kept completely in the dark about was the fact that the Theranos devices were plagued by fundamental internal issues, major technological failures. The sources indicate Theranos was actually running many of the tests using standard, commercially available non-Theranos lab equipment, while claiming to Safeway they were using their revolutionary Edison device. It was a complete facade.
And this high-stakes deception, it wasn't just limited to fooling corporate partners like Safeway, was it? It extended right up to potential regulatory approvals and even military contracts.
That's exactly right. The company repeatedly failed to produce a crucial letter they needed from the FDA, one that would back Theranos' regulatory stance for its devices. This letter was apparently a prerequisite for approving a proposed experiment involving the devices with the U.S. military, potentially in Afghanistan. But even though they failed to get that fundamental regulatory backing, the company just kept pushing, kept trying to market the devices to the military anyway.
And all the while, this whole charade was being propped up by staggering amounts of investor money and influence, which provided this kind of shield of credibility. The sources note Rupert Murdoch, the media mogul, was Theranos' single largest investor in its final funding round. He poured in $125 million after meeting Holmes at some Silicon Valley gala. I mean, that massive infusion of cash and the implicit endorsement from such a powerful figure, it must have helped obscure the deep-seated fraud for a very long time.
Absolutely. And if we rewind a few decades, moving into high finance, we see a similar kind of audacious disregard for rules and regulations with the big insider trading scandals of the 80s involving figures like Ivan Bojeski and Michael Milken. The scale of the manipulation described in the sources is just extraordinary. Milken, for instance, was engineering these complex artificial tax losses for Bojeski, effectively helping him cheat the American taxpayer out of millions.
And it was such a closed, powerful system they operated in. The sources detail how Milken's incredible, almost monopolistic power in the junk bond market allowed him to secretly repay Bojeski over $10 million in debt in less than 6 months. And critically, as the source notes, this was done without writing a single check. It shows how financial elites could manipulate the system, settle massive obligations completely off the books, totally hidden from regulators.
And that pattern of evasion of powerful figures seemingly untouchable, it unfortunately continued right into the 21st century. You just have to look at the long-running drama surrounding SAC Capital. The sources highlight the case of Matthew Martoma. He was facing a very long prison sentence for his role in a massive insider trading scheme. Yet he steadfastly refused to testify against his former boss, the hedge fund titan Steve Cohen, even when prosecutors offer him multiple opportunities for a significantly lighter sentence. His motivations for that silence, they remain a lasting mystery, apparently, even to the federal prosecutors involved. But it really illustrates a fundamental breakdown in the mechanisms of justice, doesn't it? I mean, the inability of the government to flip key witnesses to actually expose the leadership structure behind massive financial crime.
And these patterns of circumventing rules and accountability, they're definitely not limited to just finance or Silicon Valley tech. The pharmaceutical industry provides a truly devastating example with Purdue Pharma and the OxyContin crisis. The deception here was, well, it sounds like it was structural right from the very beginning, even involving the FDA itself.
Yeah, the sources state that Purdue initially had absolutely no evidence that OxyContin was any less prone to abuse than other existing opioid painkillers. None. Yet somehow the FDA allowed them to make precisely that claim in their official marketing and promotional materials. And that FDA approval essentially opened the floodgates for this systematic, corporate-mandated campaign of deception carried out by Purdue's massive sales force.
And this campaign, it wasn't haphazard, it was highly coordinated. The sources mentioned field notes recovered during investigations that revealed a heavily scripted campaign. Sales reps were given specific lines, specific instructions to repeatedly tell doctors, pharmacists, anyone who would listen, that less than 1% of users became addicted to OxyContin. a blatant falsehood. And the really disturbing visual climax of this, described in the sources, was when investigators actually mapped these fraudulent claims being reported by sales reps across the entire United States. Eventually, the map showed that almost all the states were colored red, indicating where these lies had been systematically spread. It was a planned, systemic, profit-driven fraud with utterly devastating consequences for communities everywhere.
Which brings us to a really crucial and perhaps chilling lesson about accountability, especially in environments where financial power and political power are completely intertwined, almost fused. The sources cite the specific fate of a Russian businessman named Valery Morozov. He actually used a hidden camera to expose a high-ranking Kremlin official, soliciting a huge kickback, 12% on a $500 million contract.
So he got the evidence. What happened next? I mean, that sounds like a clear-cut case, right?
You'd think so. But what happened next is a truly chilling lesson in systemic failure, or maybe systemic corruption. The sting completely failed. Instead of the corrupt official facing any punishment, Russian prosecutors opened an investigation into Morozov's own company. The entire mechanism of accountability was turned back against the person who tried to expose the wrongdoing. Morozov was eventually forced to flee Russia and seek political asylum in Britain. The lesson sent to anyone else thinking of challenging the system was brutally clear: do so, and you will be destroyed. What's fascinating here is you see this pattern again and again, how quickly the very mechanisms that are designed to ensure accountability, whether it's FDA regulations or investigative journalism trying to uncover truth, or even law enforcement stings like Morozov's attempt, how consistently they are circumvented, blocked, or actually turned against the challenger, especially when they come up against immense financial or political power. It's like the sheer weight of that consolidated capital acts as an almost impenetrable shield for those at the very top.
That failure of accountability, in many ways, it feels like the natural, almost inevitable consequence of this relentless, almost pathological pursuit of what one source called ubiquitous control, which seems to be the central driving force we see in nearly all successful giants, whether they're from the 19th century or today. #Tech4. Scaling, disruption, and the pursuit of unchallenged control.
Yeah, and we can trace this exact ambition, this drive for total control, back over a century. It really demonstrates that the underlying strategies for achieving market domination remain remarkably consistent, regardless of the specific technology or industry involved. Johnny Rockefeller Sr., his entire strategy, everything he did, was laser focused on achieving what the sources term ubiquitous and unchallengeable control over the American oil industry. Monopoly, basically.
The sources paint a really interesting psychological picture of Rockefeller, don't they? Noting this tension in his character. On the one hand, meticulous, almost obsessive thriftiness in small things, but then contrasted sharply with this sheer audacity, this boldness in the larger strategic moves. He was obsessed with efficiency, yes, but it feels like that obsession masked an even deeper drive for total leverage, total control.
Oh, absolutely. And that quest for control went way beyond just being efficient. It required getting proprietary information nobody else had.
Oh.
And yeah, at times it involved outright industrial espionage. There's a specific anecdote cited in the sources about Rockefeller bribing a rival refiner's bookkeeper, a guy named Teagle. It's a perfect historical parallel to the modern drive for data control we were just talking about with AI in China.
Tell us a bit more about that Teagle incident. What exactly did Rockefeller get?
Well, Rockefeller basically wanted to know everything about his competitors' operations, their costs, their shipments, their margins. So he bribed this bookkeeper, Teagle, to secretly provide him with transcripts of the rival company's daily activity. This included incredibly detailed shipment information, production costs, customer lists, everything. This secret proprietary information gave Rockefeller just unchallengeable leverage when it came to negotiating deals, setting prices, squeezing competitors out. He understood way back then, long before computers or the internet, that information control is market control. Okay, fast forward to the modern era. We see similar underlying strategies, definitely, but maybe executed in different ways. Look at Richard Branson and the Virgin Group. His growth model wasn't really about monopolizing one single sector like Rockefeller. It was built more on these lateral leaps, as the sources call them, moving from, say, records to airlines and then later to Virgin Money, all centered around this consistent brand promise of service value and shaking up established players. Yeah, and what's particularly interesting about the Virgin approach, according to the sources, is the financial strategy that underpinned all those leaps. Branson apparently prioritized reinvesting virtually all the profits generated right back into the rapid lateral expansion of the Virgin brand into new areas. This meant, operationally, the Virgin Group was constantly running on what one source called a thin line between success and failure. They never built up massive cash reserves, But they achieved this incredible market ubiquity and constant disruption through sheer momentum, always reinvesting, always expanding.
Amazon is another, maybe more obvious modern example of pursuing market ubiquity, but perhaps more through structural dominance than Branson's brand leaps. Jeff Bezos famously set out to build the everything store.
Right. And the development and growth of Amazon Web Services, AWS, truly cemented that everything image, maybe in a way retail alone couldn't have. AWS enlarged Amazon's whole scope far beyond just selling books or electronics. Suddenly, Amazon was stocking its shelves with these totally incongruous technical products. Spot instances on servers, terabytes of data storage. It fundamentally repositioned Amazon as essential infrastructure for huge swaths of the internet and the corporate world. And it's controlling that proprietary infrastructure that ultimately grants the kind of unchallengeable control Rockefeller sought.
And the pricing strategy they used for AWS, particularly in the early days, perfectly illustrates Bezos' long-term focus on achieving absolute dominance, even if it meant sacrificing short-term profit.
Oh, it's a classic famous example of strategic loss leading, isn't it? The story goes, when they were first pricing the basic EC2 compute instances, an employee apparently proposed charging 15 cents per hour, a price designed to be profitable right away. Bezos reportedly just unilaterally revised that down to 10 cents per hour. He insisted on treating it like a utility pricing. The priority was achieving massive market dominance, making AWS indispensable to startups and established companies alike, even if it meant losing money on each instance initially. He was playing the long game, establishing the idea that market share is the ultimate prize. And that theme connects him directly back to the railroad tycoons of the 19th century, that same mindset.
That relentless drive for massive scale, for market share, it must demand incredible internal fortitude from the leaders. And sometimes it seems a kind of humbling realization that the original idea that started it all needs to evolve or even be left behind.
Absolutely, that's a great point. The sources cite the founders of the clothing company Bonobos. They apparently reached a point where they had to realize that the business itself had become bigger and more important than the idea, your idea, on which that business was originally built. The source suggests it takes real courage for a founder who's often deeply attached to their initial concept to actually move away from that familiar, maybe sentimental, starting point and embrace what the scaling enterprise objectively needs to survive and thrive.
And just sheer perseverance seems non-negotiable in that startup world, trying to reach scale. We see this clearly in the early struggles of Airbnb, mentioned in the sources. Apparently, after getting an early boost from hosting people during the Democratic National Convention, their user numbers just came crashing back down, which seemed to validate all the skepticism they were hearing from venture capitalists.
Yeah, they were reportedly rejected by something like 20 different investors in those early days, 20 rejections. Yet they just kept pushing, kept iterating, kept going despite those really demoralizing initial returns. It seems that ability to secure that ubiquitous, unchallengeable control we keep talking about, it often demands just outlasting the critics, surviving the temporary setbacks, and demonstrating the kind of sheer grit that has to match the financial audacity of the giants like Rockefeller or Bezos. So if we try to connect all this back to the bigger picture, I think the core insight that really unites Rockefeller's oil monopoly, Amazon's infrastructure dominance, the financial giants using LBOs, and even the data monopolists emerging in China, is that lasting success, that kind of dominant success, seems to hinge on securing leverage. Leverage through proprietary information like Rockefeller did, leverage through essential infrastructure like AWS, or in the modern sense, leverage through controlling massive, unique data sets. And the resulting concentration of power and wealth, whether it's historical or modern, it just demands constant, rigorous scrutiny, precisely because the ambition driving it seems fundamentally resistant to external checks and balances.
Okay, so we've covered a lot of ground here. We've navigated these shifts in the global economy, particularly towards data. We've examined the sort of rigid structural mathematics behind wealth inequality with GG dollars. We've reviewed that very thin line between vaulting ambition and outright failure or fraud, as seen in cases like Theranos or Purdue. And we've analyzed that relentless historical pursuit of market control.
Yeah, and the structural forces that the sources reveal, they seem pretty clear, don't they?
Yeah.
Whether it's the fundamental shift towards massive data accumulation, especially in China, or that persistent mathematical formula, well, G dollars, governing how inherited wealth behaves in the West, the underlying forces determining who gets wealthy and how concentrated that wealth becomes, they seem deeply resistant to simple fixes or corrections. We saw that even $125 million from a media titan didn't ultimately save Theranos from its fraud being exposed. But at the same time, the sheer financial power, the political connections of perpetrators and some of the other scandals we discussed often seem to shield them from ever truly facing justice.
And that key tension just remains, doesn't it? The past continuing to devour the future, the concentration of financial assets, of capital, in the hands of those who already own it, continuing to outpace the growth that comes from labor, from working.
So maybe the final thought to leave with you, our listener, is this. Given the truly immense scale of data power and financial power that's now consolidated in the hands of just a handful of massive U.S. and Chinese corporate giants, giants who, as we've seen, often operate with this explicit mindset of achieving unchallengeable control, what new kinds of checks, maybe institutional checks or perhaps even technological checks, will actually be necessary to genuinely prevent the past from devouring the future entirely? What does real accountability look like in this new era?
That really is the ultimate question of accountability for our time, isn't it? Thank you for diving deep with us today. We hope this gave you plenty to think about. We'll see you next time.